Look guys, I said it before, ready properties, especially in good performing areas in Dubai, is the way to go. Of course, you need to have the cash ready or you need to be approved for a mortgage. But if you do have that, then you should seriously consider it, especially right now. Most people think that Dubai's property market only survives on off-plan launches. The truth is, right now, the best time to buy is in the ready segment. The geopolitical escalation in the Middle East did slow this sentiment temporarily, but especially in the off-plan launches. But it also created ready property opportunities that many property investors are now ignoring or simply misunderstanding. This video breaks down exactly why ready properties today are one of the smartest playbooks you can have, especially compared to off-plan, based on real investor behavior, rental demand trends, and strategic shifts we're seeing right now. I'm gonna give you data-informed and investor-oriented insights that will help you analyze it and evaluate all the opportunities accordingly. And as always, bringing you the unbiased truth in real estate. So hit that thumbs up button, subscribe, and let's get into the video. Let's start by acknowledging the elephant in the room. The US-Iran escalation, including the strikes on UAE territory, did impact sentiment, with real estate transactions dipping as investors paused, as expected, to reassess. For example, Dubai real estate saw a roughly 24% drop in transactions in Q1 2026 as uncertainty peaked before signs of recovery emerged in early April. Transactions and buyer inquiries softened, particularly among foreign investors and speculators. But here's the key investor takeaway. Crisis affects the sentiment, not the fundamentals, especially in the ready property market. The conflict obviously paused purchases, but it did not collapse the rental market or structural housing demand. Instead, it reshaped the behaviors and created opportunities in sectors that will produce cash flow now and not years later. Yes, maybe that cash flow is not gonna be as high as it used to be in February or January, but is still much higher and much more competitive versus all the other capitals in the world. And you have all the data on DXB Interact. You can check it out and compare it on your own so that you see that this is really unbiased and it's the reality. Number two is that the ready rental demand is holding. In areas like Business Bay, JLT, Silicon Oasis, Meydan, the majority of residents are salaried professionals. Even if some left temporarily during the peak tensions, they return or are returning. They still work for companies, need visas, need housing, and they earn salaries. This means that 1-bed or 2-bed ready units in this segment will still see constant demand, cash flow remains predictable, and vacancy risk stays quite limited. This is the structural demand that I was talking about. It doesn't get unchanged, but it is not speculative, so you really can plan it ahead and you can see how it reacts in the future. Where demand is more flexible, compare those areas that I previously mentioned with these ones: Greek Harbor, Dubai Hills, the Greens, Palm Jumeirah, and the Jumeirah area in general. This community have entrepreneurs, remote workers, freelancers, and affluent families with kids. These groups are more flexible geographically. If uncertainty rises, they can travel, stay abroad, delay returning. This specifically affects larger 3 to 4 bedroom apartments, townhouses, and villas. These are lifestyle-driven areas, and they are affected less than the salaried hubs. Not catastrophic, but absorption may slow slightly in these segments. Why is off-plan more sensitive right now? Off-plan depends heavily on forward confidence, future price expectations, locking in capital for 2-4 years, and that is certainty. So belief in the long-term stability as well. In uncertain geopolitical environments, individual investors will hesitate. The bigger ones, the bigger investors who buy in bulk, who are looking for distress sales, who can really be very liquid and act quickly on those opportunities, those will still look in the off-plan segment. And don't get me wrong, they will make a lot of money on the capital appreciation side. But for individual investors who need cash flow, who need more stability, this will be the case. They ask, why lock my money? What if sentiment shifts again? What if the timeline stretches and there are delays because of that? We've seen that before. Ready properties eliminate that delay. You buy today, you rent tomorrow, you generate yield immediately, which reduces uncertainty exposure. As mentioned, for large institutional players, off-plan distress can become an opportunity. However, simple off-plan launches, especially for individual investors, ready is currently more defensive. Current market signals are also supporting ready properties. Here's what we're seeing right now. The rental market is acting normal. Tenants are renewing contracts. And to be honest, I was looking at the renewals in the properties that I held, and I was an investor and also a landlord in the past. And those averages are actually higher than what I was renting them out last year, for example. So it's interesting. On the other side, there's no panic selling. However, I've seen some discounts even in my past buildings. So I'm looking there as well. Like I told you, and you probably watched some of my previous videos, I did sell most of them, but I'm really interested to get back in at the right price. So definitely there is no mass selling. There is not really distress kind of situations, because I think most of those, they happen after COVID. However, right now, I do see some slight discount. Investors are shifting from speculation to yield. This creates some kind of a strategic reallocation from the buy early, wait for handover, and get some potential capital appreciation, which is the typical signs of these off-plan launches, to more of a kind of buy now, earn now, and protect the downside. And if you will have some upside, as in capital appreciation in the long term, because you are focusing on very long term, then that is really good. If you're actively looking to purchase some ready units right now, you need strong on-ground representation. You need to know the areas, you need to know the actual towers and the real units. That's where my agency partner, WIM Real Estate, comes in. WIM operates fully on the buyer side and focuses on ready property negotiations, secondary market deals, access to motivated sellers because of the past experience, proper due diligence, and transaction execution. If you're serious about acting on ready properties in Business Bay, JLT, Silicon Oasis, Shoba Heartland, and Maidan, having a strong buyer side agency by your side makes a real difference. All the links are in the description below, so check them out right now. And at the same time, if you want structured, independent investment guidance before acting on a property, that's where we at Agora Advisory come in. Based on my one-to-one offer structure, we provide consultation calls, strategy sessions, UAE property buying process advisory package. For relocation clients, we have a Dubai setup advisory package. And for those looking for those real deals that you want to find, we have a property sourcing service, which is fixed fee, no affiliations, and buyer focused. Same as I would be sourcing it for myself and my friends. So if you're interested in these services, links are, as always, in the description below, and I'm looking forward to speaking to you on the calls. So why now is the window for ready units? Off-plan sentiment is obviously softer. Some sellers are slightly more negotiable because obviously that impacted them as well, and they are as uncertain as you are, the buyer. Rental demand in salary-driven areas occupied by professionals is still there, and ready properties provide immediate cash flow. Risk is now way lower and more justified compared to locking the money in for years and not being sure on when that would be handed over to you and when you will actually start seeing some profits. It's more of a cycle shift play. It's not looking at a crash or whatsoever, but you really need to understand the cycle. It's recalibrated and ready assets, especially one beds in salary-driven communities or two beds in communities where people actually have to be on site in Dubai, are positioned more defensively with upside potential once full confidence returns. If you're positioning capital in Dubai today yourself, then you have to ask, do you want cash flow or just simple future promises? And by the way, those promises might be real for some projects and from some areas. But generally, right now, I think if you really want to put your money to the best play, you really need to look into some of those ready units in the areas where can you literally rent it out in 1 or 2 days. As always, bringing you the unbiased truth in real estate. And if you like this video and want to hear more on my opinions on my past clients or current clients, situations, on breaking down the deals and so on, then don't forget to subscribe. It means the world. And leave a thumbs up and a comment in the comment section below. So with that, I thank you for watching, and I'll see you in the next video.